And we know our community, and usually sometimes the questions that I ask, they're my personal questions, or sometimes it's questions that we get in our inboxes, or our students will email us, on Discord or whatever, and I just kind of lump them all into kind of like one
Yeah.
question. So this is one of those questions, right? It's part my question, part other students' questions that have sent me questions on energy. So here's the question for you. You have a wonderful, pattern here forming with energy. But we know we've got earnings ahead of us. And for those of us that are already in energy, meaning we are long-term investors of energy, we've been writing covered calls through the good times and aggressively writing them on the, through the bad times. And we've gotten all that part. And I'll give you 1 second, specifically that we've talked about here on Queen's Court before, and we can talk about this, and we can use it for multiple stocks. We could look at ExxonMobil, and it'll be the same conversation and everything
Yeah.
else. Let's focus on OXY again, because we had this on a couple of weeks ago. And so here we are with OXY. Pattern looks, quite similar to the energy, ETF itself. And so for those people that are already in individual stocks, writing covered calls, doing the whole, usual. At this level here, where you've got a nice pattern forming here, is the question is to cover or uncover, but also keeping in mind that you've got earnings coming up ahead, and putting all that together with a pattern like this. And for those that are not in energy already and are looking to get into this space, should they wait until we go past earnings, or get a jump at it and do, and trade the ETF instead? So there's your like multiple questions, all kind of
Well,
bringing it to the same
if you
thing,
have
right?
not been trading energy, I do not recommend starting trading energy 3 weeks before a very important earnings season.
Right.
No, like that's a no. Like if you're in energy and you've had some experience here, it's a different conversation for me.
Correct.
But if you are waking up to energy, you don't wake up in a choppy, volatile market 3 weeks before earnings and say, "Hey, let's giddy up and go." Like
Mm-hmm.
that to me is just like a concern, right?
Yeah.
Let's first answer the question of risk graph. Okay.
Mm-hmm.
From a directional position, there is some swing trades here to be had. No doubt about that. But the question on risk graph control is more to the longer term investor. And
Yep.
so let's kind of focus on that first. Yes, I do think covering is important for the most part in this marketplace until we break out of resistance. I think when you break out of resistance at that point, then it's easier to open up that risk graph and take in a little bit of control, because the breakout in energy could lead to some significant upward movement in price. And so when you're playing underneath that resistance level after a pretty big sell-off, yeah, I don't think this one-day hammer candle is enough in specifically OXY to say let's open up that risk graph coming into earnings. But I also feel if you're making a decision on a long-term investment to cover or not in the specific energy field, I do think you're making the decision to open it up to a certain extent. And when we're talking about opening it up to a certain extent, for example, let's say you're looking at OXY here, and let's just say you have 100 shares of OXY, right? We'll just have 100 shares of OXY. And so when you're looking at covering something or not, I'm just going to go out, 31 days on the weekly here. You should be fine that on OXY. Let me come down, move that one. Okay, so let's just go 30 days. And so to cover or not is not the real question to me. It's where to cover.
Yeah.
Okay, is the real question to me. And so, no, I don't think we're seeing the situations where it's like, ooh, let's just open up everything and let it rock and roll in front of earnings. I think that could happen post-earnings, kind of as we're coming into earnings, because you don't want to be covered on earnings. If you're going to cover on earnings, you need to add a put option and color the trade. And again, let me say that very, very clearly. If you are going to write a covered call on earnings, you cannot just have one side of the ledger. You've got to collar the trade to cover both sides of it. And so you collar the trade on earnings, not cover the trade on earnings, because if you cover, you are limiting your upside potential while you still have unlimited downside. By
Mm-hmm.
adding the put option, you are basically collaring the trade, reducing the directional risk out of the equation. And so, in terms of covering on earnings, that has to be based on collaring. Either you let a long-term investment go through it, or you collar it and you remove or you remove the position. So you have a couple options on holding through earnings. Either one, you leave it uncovered because you don't think there's too much risk in the volatility. You buy a put option to protect it, or you collar it. You do not just cover an earnings position, because if you all you do is cover an earnings, the only thing you're in essence doing, if we come down to just sell that 41 delta contract, for example, the only thing we're doing is we're locking down our potential to the upside. Whereas look at the unlimited loss to the downside.
Mm-hmm.
That is not a positive situation going into earnings. And so, just by way of example, what you would do is you would collar the trade by adding a put option to the equation. And by adding a put option to the equation, depending on how aggressive you want to be, you could limit the downside a little bit more. So again, holding earnings is it's not a cover or not. It is a collar or protect or not. It's got to
Mm-hmm.
be either none or
Or
both. That's what it has to be. It cannot just be one of them in terms of the cover.
right.
Now, specifically on Oxy here, I think what you're looking at here, you're saying as long as it stays underneath 70, I want covers.
Mm-hmm.
Okay. As long as it stays underneath 70, which is kind of 71 really, but I'm just calling it 70. You
Yeah.
got a base over here at 70, and you got the tick over here at 70, which coincides with resistance over here at 70, 71. And so I think as you're playing underneath that, and again, it's pretty volatile environment here. I think you just got to pick your number here and say, okay, I need to be anything underneath 70. I'm not willing to cover that, because this could go right back up to 70 fairly aggressively, hold
Yep.
resistance the same way it did over here. And so I don't think covering under 70 is the question. I think, okay, we got to cover above 70. And so if you are covering on a bullish retracement, in a normal environment, I wouldn't cover a bullish retracement. Not in
Mm-hmm.
any capacity would I cover a bullish retracement, but this is not a normal economic or fundamental environment. And
Right.
so I think it's when in doubt, cover,
Right.
right? When in doubt. And so, but again, you don't have to cover it like aggressively. You don't got to choke up the stock here. You don't have to
No.
cover it at 66, for example.
Let it breathe a little bit.
Exactly. And so let it move. Let it move a little bit, right? So it's really a decision where you want to cover it to me. And so when you're looking at that, let's go to the open interest delta theta here. And so typically speaking, as the markets are going down and you want to cover that directional risk to the downside, you're selling a delta of around 0.40. Sometimes when you want to be very aggressive to offset risk, it might
Mm-hmm.
even be an in the money covered call, right?
Correct.
Where you sell an at the money or an in the money covered call. But that's only when you're trying to offset a lot of loss to the downside. When you have that question that you're having right now, ooh, I like this bullish retracement. We're coming into earnings. Should I cover or not? I think you can get a little bit of cake and eat it too mentality here.
Mm-hmm.
Well, I don't want to cover anything under 70, so I got to go out a little bit more. The question is, how far do we want to go out? Well, to me, you got to get above this 71, 72. You don't
Okay.
want to cover at 70 because you're coming at resistance. You want to cover
Mm-hmm.
slightly above resistance here, allow that resistance level to certainly work out. And so you want to say, okay, 71, 72, let me get it deep. In fact, I can go all the way up to 75 here. That massive resistance level, that significant whole number at 75. I can go out 31 days. And even if I go all the way out to 75 of that 24 delta contract,
How much you're bringing in.
you can still bring in about $1.40 a premium here, which is
Mm-hmm.
still about over 2% ROI on the covered call. And so that's what you can do in volatile conditions. When you're seeing this type of volatility, you can go out of the money a little bit more. And so for me, it's not a question of to cover or not in this environment. It's a question of how aggressive do you want to cover in this environment. And for me, in Oxy specifically, Quite frankly, I think 75 stands out.
Well,
So basically,
that,
what I'm
that was
saying is,
that was the general audience question. So now let me ask you my specific one because I'm in
yeah,
Ox, right? So
yeah.
knowing my style of trading, knowing how busy I am in my life,
By the way, real
my
quick, Em,
yeah.
real quick. The
Hmm.
75 allows you growth up to 75 and the cash flow on top of it.
Yep.
So you're getting a
So
little bit of cake and eat it too there.
that was my question. So
Yeah.
for somebody like me who is not in the market every day, the type of trader I am. I'm more passive and
Yeah.
investment mentality. I don't want to have to come in here and manage this, this covered call every day or every week. I just want to kind of like, put it on and know I've got some time and I've got my cushion. 72 or 75.
It's 70. It's for you.
Yeah.
It's not even close to 75.
The
Nah,
greed in me,
nah.
wanted to go 72. And I'm like,
Well,
you know,
yeah, but you answered your own question.
I know. That's why
Right?
you gotta talk
For
me
the
out of my craziness.
passive, like you're the queen, right? You are dynasty investors, right? You're not Coach Frank that's going to come in here and microanalyze the intraday data. Right,
Nope.
you're not going to sit here every single day like Coach Gino and sell 14,000 butterfly trades that expired this Friday.
Yep.
You're not. That's not you. You're going to park your money in a long-term investment. You're going to write covered calls. You're going to cash flow. You're going to compound, and you're going to do it the right way. You're the Warren Buffett. That's why we call you the queen. So for you, like for Coach Gino, for example, yeah,
Uh-huh.
Coach Gino would cover 70 and then manage 70. Like that,
Okay.
that's what he would do, right? Coach Tyler would sell 72 and manage 72. Coach M would say, I don't want to do any of
Any of
that. I want to go on my 14th vacation in the last 14 days, and I want to go jet travel the world. I don't want to make these decisions. Well, guess what? That's you still do the same thing. You just say, no, let me sell the call at 75. And
Yeah.
so for you, no, I don't even think it's a debate. It's 75. For the active trader, I think they can lock it down at 72, bring in a little bit more cash flow, have a little bit more management. You still got to
Listen.
put the work in, right?
Yeah.
If you get a little bit more premium, just means you're in front of the market a little bit more on the management side.
You know what it was? It was that upgrade on Lulu that made me want to go for 72 because it's I gotta go buy some I gotta go shopping.
I don't think that's what the upgrade meant for Oxy. I'm just throwing it out there. I just think the upgrade in
Mama needs to go
Lulu.
buy some Lulu pants. So I thought if I
Uh,
sell if I sell for
listen,
70,
listen. Hold on,
pick up a little bit more
hold
cash
on.
flow. Look at the difference in
All
dollars.
right, you greedy little dynasty investor, you. Can you not buy Lulu pants for $125? I'm not a Lulu consumer.
No,
I'm a hood type
I
guy.
want the 200 ones. I want the $200 ones, not the 120 ones. What are you
Well,
kidding
quite
me?
frankly, to get the non-recycled ones, you need to be on the active side, darling, and
But
not take one of your 14 vacations.
let's put a stop loss on this. We're done with this conversation. This is what upgrades and downgrades that don't make
Oh
sense
my
get us
goodness.
to do.
All
Oh
of a
boy.
sudden, Lulu gets upgraded, and Emily's like, let's
Ooh.
sell a 0.50 Delta contract on Oxy so we can go party. Like, one does not have to do with the other.
Okay, thank
Um,
you, Matt, for
but
that analysis.
um, 75 makes
Okay.
sense. In fact, Em, let's just go 76 just to wipe away some of your greed right now.
You're on punishment. You're selling the 76.
All of a sudden, Emily's theta fading on a Friday. Goodness.
Oh, goodness gracious. All right. Well, thank you very much for that analysis on Queen's Court. That will